On behalf of the Personal Financial Planning section of the AICPA, this is Bob Keebler, and welcome to Tax Tips for Effective Income Tax Planning. The AICPA Personal Financial Planning section is a premier provider of information, tools, advocacy, and guidance for CPAs who specialize in providing estate, tax, retirement risk management, and/or investment planning advice to individuals. The PFP Specialist Program allows CPAs to gain and demonstrate competence and confidence in providing estate tax, retirement, risk management, and investment advice to individuals, families, and business owners through experience, education, examination, and a resulting credential. Today we're going to talk about trust tax planning. Keep in mind, before we even start this technical presentation, I want you to think about the demographics. We are starting to see the baby boom generation pass away. People born in 1946 are now almost 70 years old. Husband will die, wife will die, a bypass trust will be created, gifts will be made to trust for children and grandchildren. You as the CPA will be responsible for preparing these trust returns. That's the easy part. The hard part is, what do we do to reduce the taxation at the trust level? We need to think about bracket management, and remember, I'll show you in a moment, bracket management is kind of upside down for trusts because of the high 39.6% rate, coupled with the 3.8% surtax. We'll also talk about reducing income taxation with trust distributions, making distributions either during the course of the year or under the 65-day rule, and pushing that income out to the beneficiary's returns. Keep in mind, if I make a distribution, if I'm the trustee and I make a distribution from the trust to a beneficiary, the beneficiary pays income tax on that ordinary income, not the trust. There's a lot of discussion lately, mostly led by people like Dick Nenno, Jonathan Blockmacher, Steve Oceans, on the state income taxation of trusts. Where do we cite as trusts? Should we put our trusts in Nevada or South Dakota or Alaska? We want to think about, does Delaware make sense? Very often, you're going to cite as a trust in a particular state because there's no income tax, and oftentimes because state property law beyond taxation is very favorable. For example, there's a rule against perpetuities, which says a trust can basically run forever. Some states have abolished that rule, or abolished the typical rule against perpetuities, that a trust can go life and being plus 21 years. They have gone to a basically no wrap rule where a trust can run forever. You may want to cite as some of your wealthiest clients' trusts in those states. Now, this is what I'm talking about with the 39.6. Keep in mind, once in 2014, this is looking back a year, at $12,150, this year I think it's $12,300, you are going to see the 39.6% bracket. Now compare that to your individual return, which starts at about, for a married couple, at about $460,000, give or take. So trusts have some discrimination against them, and our job is to figure out how to make investments for trusts more efficient, shifting more into capital gain, and then working on distributions on an annual basis. So remember, under Subchapter J of the Code, income is taxed either to the trust or to the beneficiary. If income is accumulated, then the income is taxed to the trust. So if the trustee keeps the funds in the trust will pay income tax on those funds. However, if income is distributed, paid out to the beneficiaries, then the trust receives an income tax deduction and the beneficiaries report taxable income. Now, when I use the word income, I'm talking about qualified dividends and interest income, rental income, etc. I'm not talking necessarily about capital gains. Although there's a way to distribute capital gains out of a trust, it's a more difficult process than the ordinary income process, and that's covered extensively. I have a lot that's been written on that. John Goulsbury last year at Heckerling did a very nice job of laying out all of the distribution rules. Jerry Doyle continues to teach this at the AICPA's Advanced Estate Planning Conference, so we're working hard to get the word out on this. Now, everything in the world of trusts under Subchapter J floats around D&I. D&I is the heart, the epicenter of Subchapter J. And D&I determines the amount of a trust or estate's income distribution deduction. It determines how much the beneficiaries must report has income on their returns, but it also determines the character of that. When income flows out of a trust, it retains its character in the hands of the beneficiary. So if my trust earned $100 of dividends and that flows out to me, I will report $100 of qualified dividends on my personal tax return. Now, D&I has been around for a long time. The statute works pretty much perfectly, and it acts as a ceiling for the amount of the deduction, and it also acts has a ceiling to the amount that I have to report as a beneficiary on my return. So if we paid out $100, typically the beneficiary is going to pick up $100. Part of what we have to do is learn how to prepare these trust returns even better than before. And we have to learn the planning better, because you see, with such a high tax rate at the trust level, we either need to be very efficient with our investments, or alternatively, we need to have a distribution strategy that works. Now remember, I know you know this, but just a quick review. Under the law, there is a 65-day rule, specifically 663B of the code. It basically says that if I make a distribution as a trustee to use the beneficiary within 65 days after year end, that distribution counts for the prior year. So, trust earned $1,000 of income in 2015. In February of 2016, you as the trustee make a distribution of $800 to a grandchild. So the trust earned $1,000, you just paid out $800. The D&I deduction will be $800. The trust will report $200, and the beneficiary report $800 on their return. Now, this is an election that must be made by the due date of the return, including extensions. The election, once you make it, is irrevocable. It's an annual election. So for every trust return you prepare, not only do you have to have a tickler for the accountings, for the tax return, but you want to have on your tickler the estimates, and you want to have on your tickler the 65-day distributions. Now, it's a sidebar, but the 65-day rule, the date is always early March, usually March 5th or March 6th. Obviously, that changes when we have a leap year. Now, under the 643 regulations, this is when you can pay out capital gain. The general rule is capital gain is not included in D&I. However, under the regs, capital gains can be distributed as part of D&I if the trust document allows it or if state law allows it. This is very important. So the trust is for, imagine this, the trust is for 7 grandchildren. They're all beyond the kiddie tax, and the trust earns $700,000 of capital gains. Grandchildren need the funds. If you trap the capital gain in the trust, you're going to pay tax at 20% plus 3.8, 23.8. However, if you pay it out to the grandchildren, you'll probably pay tax only at 15%, maybe even some of that as 0% rate. So basically, if it's allowed in the trust document or under state law, the tax advisor, with the consent of the trustee, can elect to include capital gains in D&I. Very important for us to have our mind around this. Now, keep in mind also, 643E of the code provides that property distributed in kind from a trust to a beneficiary retains its cost basis. You're the trustee, you distribute out to the 7 grandchildren, each 100 shares of Procter & Gamble. And then the beneficiaries sell that. They're all 25 years old. They would take a cost basis equal to the trust basis, a carryover basis, and then when they sell it, they will pick up that capital gain on their personal return. This is very easy, very straightforward. Therefore, if the trust allows for the distribution of principal, the tax advisor can distribute it, with the trustee, of course, can distribute appreciated property to the beneficiaries if their tax rates are lower. Keep in mind, a lot of young people may even be in the 0% rate once they get beyond the kiddie tax. Remember, we're still up against the 2% floor on itemized deductions. This is a very long, laborious conversation, but miscellaneous itemized deductions for any taxable year will be allowed only to the extent that the aggregate of the deductions exceeds 2% of gross income. Okay, so we have to watch out for this, and we have to plan accordingly to minimize these deductions, which in reality will not be deductible. So basically, the AGI of a trust is adjusted for the deductions for costs which are paid or incurred in conjunction in conjunction with the administration of an estate or trust, which would not have been incurred if the property had not been held in trust. Okay? So, for example, trustee fees are fully deductible, but investment management fees, perhaps paid to a third party, may have some limitations on how much you can deduct. You do receive a small personal exemption, and keep in mind, under the D&I rules, you will receive a distribution deduction for D&I paid out to the beneficiaries. So basically, I'm just going to cite the law here. You're allowed a direct reduction to a trust AGI for expenses not commonly or customarily incurred by an individual holding the same property. For example, you need to pay the trustee, that's fully deductible. You need to pay the CPA firm to do the tax return, fully deductible. You have a fiduciary question you run by the lawyer, fully deductible, because those are expenses incurred because of the nature of the trustee relationship. Now, this all began for years beginning after December 31st, 2014. Now, these are the states with potential rate savings, okay? I've outlined the rates in different states. So you can see, starting on the East Coast, it's Delaware, it's Florida, it's Texas, South Dakota, Wyoming, Nevada, Washington State. No state income tax on trusts. Okay, that's good. And you can also see the rates in some other states. For example, California, 13.3. You're well aware of this. That's the top rate. The New York rate, people are telling me it's between 11 and 12% someplace. Between that, there's some debate. That's New York City. Minneapolis or Minnesota, 9.85. You can see where this is going. These are extremely high rates. And the issue is, can we cite as the trust in a different state? Now, not every home state allows you to do this. For example, many states will have a rule that prohibits you from setting up a trust in a different state to beat the state income tax. But not every state has that rule. Richard Neno of Wilmington Trust has done some extensive work. He has a wonderful outline which will lead you through this. But the first question you should have is, does your state, for example, if you're in California, can your client set up a Nevada trust, and will that save you state income tax? For California, the brief answer is yes. If that trust is very artfully drafted, you can do that. In some states like Wisconsin, absolutely no way you can do that, because there's a statute that says you can't. And you're going to have to look at what is the law in your state. But if you have an opportunity, you should take advantage of this. Now, if your clients, for example, move to Florida and their children are back in New York and California, then maybe what you need to do is have them create trusts while they're alive, situs them in a state where there's no income tax, and you'll have that arbitrage going for you for a long, long time. Now, the interesting trust that's out there right now is called a Ning trust, or ING. Sometimes they're called Nings for Nevada. Sometimes they're called Wings for Wyoming, or A-Kings for Alaska, or Dings for Delaware. Here's the bottom line, is you create a trust in one of those states that does not have a state income tax on trusts, and you transfer property into that trust. But what's unusual about this is this has all evolved in the last 5 years. The way you draft the trust so the gift is incomplete for gift tax purposes. That means that you do not pay any gift tax on the transfer of the trust. It also means it's included in your estate when you die. But you could move considerably more than your $10 million exemption for a married couple into a trust like this. Keep in mind, married couple has a gift tax exemption of $5,430,000 times 2. But if you had a client with $25 million of stock they were about to sell, and you were in the right state, say California, you could drop that into a Nevada trust, not pay a penny of gift tax, and when the Nevada trust sells the assets, then you do not pay any California tax. Okay, so that's a very complicated thing, and you need, high-powered lawyers to help you put this together. But this is something that you want to get your mind around, and it's a real big opportunity for us. On behalf of the Personal Financial Planning section of the AICPA, this has been Bob Keebler, discussing the taxation of trusts. Thank you for joining us today.